Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending October 6th, 2023. So let's start with a look at this week's markets after 4 days. Negative in most markets, interest rates higher, and as I'm recording this, it's prior to the stock market opening, but the bond market is trading, and with the strong jobs report that we had this morning, I'll talk about that in a few minutes. Rates are even higher this morning, long rates by about 15 basis points. Let's see how we end the day, but so far we're heading towards more losses on bonds. Corps are still holding a positive sign, but barely, so let's see where we end up. Equities, red everywhere, but the Canadian dollar was weaker by about 1% this week, so the TSX underperforming Canadian dollars. Let's see where we end the day. Again, as I'm recording this, also futures are negative on the US stock market and the Canadian stock market this morning because jobs report is very strong, bringing back anticipations or odds that we have more rate hikes or rates stay higher for longer. So good news, good economic news are bad news for the markets these days for sure. And no, there's no mistake there. The price of oil was truly down 9% on the week. More on that in a few seconds, but this is a very volatile picture that you see here, of course, in pretty much all the markets. Maybe if we can start, maybe I'll surprise you, but I'll start with an update on the wallets of US households, because there are two things that are important here. On the left, first, it's an estimate of the excess savings from US households. And, you know, we do something here that's very accounting wise. Other firms do other methods, and it's depending on who you listen to. Either we're at the end of the excess savings or there's plenty. So the estimates are pretty much all over the place. But here, if you look at the chart here, it tells you that US households still have excess savings. But why am I bringing you this chart here this week? Is because we've had data revisions coming out this week, which pushed higher and by a fair amount, by about $400 billion, the estimate of excess savings. And whatever method you look at, everyone was surprised of there seems to be much more excess savings in the US now than what we thought because of data revisions. So they just put out a fresh version of the numbers. So this is bullish for the economy, the US economy. Just it supports US households. And always remember that US GDP is made of 70% consumption. So 70% of US GDP is consumption. And if you take 70% of US GDP, you still have a number that is larger than pretty much any other country's GDP in the world. So let's say that the US consumer is the largest economy in the world. So it's very important. So this is a favorable sign. Now the question that we ask and that we keep asking is, well, do US households really need to deplete all of their excess savings to start adjusting their consumer spending habits, to start spending less because inflation is biting into their budget, because at some point the economy deteriorates, and we see slower jobs creation and all of these signs become more material? Likely not, but so far so good on the stock of excess savings in the US. But on the right, something that is a bit more timely, I would say, is that the deposits from the Department of Education on the treasuries are jumping again pretty strongly. This is how we catch the fact that the moratorium on student loan repayments is over. So now US households have to repay their debts again. They kept the principal in their debt, and it's about $50 billion per quarter that is taken out of the households' pockets, sent back to the government. Mentioned that a few times recently. But when you look at surveys, multiple households are saying that, well, they will have to adjust drastically the way that they spend because of this. And coincidence or not, but since we've seen the end of this moratorium, we see a few things happening. We see that business in restaurants is falling quite rapidly. We see less air traffic. And as you can see in these charts here on the right, suddenly the demand for gasoline is starting to break. Here we catch it by the days of supply of gasoline, which are ticking up. It doesn't look like much here in this chart, but the move was sudden, was swift, and it was enough this week to create some shock waves through the market. On the left, you have the price of oil. Last week we're at 94, now we're at 84, so that's about $10 in a week. We've seen stuff like Consumer staples in the US underperforming. Coca-Cola a company that is very sensitive to consumer spending patterns, had their worst day this week in 17 months. So you start to see that looking forward. Now there are some adjustments to the spending patterns of consumers. So backdrop is stronger than we thought in terms of excess savings, but the direction of the spending habits in the short run seem to be shifting, and markets are reacting to that. So that's for households and some reasons why the price of oil, of course, it was overextended. So when you have moves like that, the move can be exaggerated on the other side. But this is what was behind the market action, most of the market action this week. In the US, again, just bringing back, just refreshing our collective memory here about the states of US banks. One interesting stats that hit me earlier this week was that we're about to hit the 1 year anniversary of the market low, which was in mid-October 2022. If you look at history, it would be the first time in recorded history, starting around 1930, where 1 year after a market low, the US bank stock index is in negative territory. So after a year, or since October 2022, bank stocks are negative and not positive. First time that we would have seen something like that. So it tells you that there's still some nervosity, some anxiety versus towards banks in the markets. And we don't have yet the Q3 numbers here, but remember that in Q2, the end of Q2, the size of unrealized losses in banks was very large, and as interest rates rise, the value of the bonds fall, the price of the bonds fall, and they need to account for those unrealized losses on their books. And now the latest data that we have for late Q2, it was about 25% of the equity of banks that was exposed to unrealized losses from these securities. So looking forward, with the rise in interest rates that we've seen recently, should put more pressure on banks. So this issue remains in the back burner for now, but it's something that we should keep in mind when we assess the state of the U.S. economy. And maybe the markets right now are telling us that we need to be careful still about the U.S. banks and the U.S. financial system. Looking at the job report in September in the US on the left, Canada on the right, both sides we had strong surprises. Twice the consensus is in the US, and even it was the number that we had was above even the most optimistic forecast that was surveyed by Bloomberg this week. On the right in Canada, 3 times the expectations. Expectations were for 20,000. We had 64,000. So the labor market remains strong on both sides of the border. We have a Bank of Canada decision on October 25th and a Fed decision on November 1st. So no more jobs data until then. So if you look at this, we still think that central banks should stay the course, keep rates high for a while. Not really necessary to hike one more time in our opinion, but let's see. I think there is a case for more hikes by the end of this year for sure. So we don't think it's impossible. It's just not our base case, but we wouldn't fall off our chair if we saw more hikes based on this. So next week we'll have inflation in the US. That's going to be a very important print. In Canada, inflation has been sticky recently. So central banks, of course, stay a factor at play here and causing some more volatility in the markets, of course, as this is getting priced in. And very important, and I'll leave you on that, the wage pressures in the US seem to be fading slowly. In Canada, they're pretty, remain hot, the wage pressures. And remember that Governor McClem in February in Quebec City told the crowd that if wages continue to grow at a pace of between 4 and 5%. Those were the words that he used. Well, this would not be consistent with inflation sustainably getting back to 2%. And since then, wage growth has remained on the top end of that range. So the Bank of Canada remains a factor here for sure. So I'll wrap this up with what to watch next week. Bloomberg Nanos Confidence Survey in Canada, building permits, existing home sales, very important data for the Canadian housing market. In the US, the Small Business Optimism Index from NFIB, the FOMC meeting minutes from September 20th, CPI inflation a bit lower, but from 3.7 to 3.6 is the consensus right now. Let's see what we have next week, and we'll have the University of Michigan sentiment survey also on Friday. So that wraps it up for the week. You can find us on ia.ca/economy to get the weekly review, to get the podcast. You can also find us on iagam.ca, iagam.ca/insights for the monthly, for the weekly insights, and for all the material also produced by my colleagues at iagam. So it's always a pleasure to serve you. I'll see you again next week.